The market is constantly changing. So there are trading plans and concepts that work better nowadays than they did years ago. And the other way around, there are concepts and trading plans that actually got worse over time. So if the market is changing, then so should you in order for you to become profitable and to stay profitable. It used to scare me a lot when people told me the market is constantly changing because I thought I needed a complete new trading plan every single week. But that's not the solution. Now, in order for us to understand what the solution then actually is, we need to understand what it means that the market is constantly changing and how you can always be one step ahead. So you never have to worry about the market changing anymore. Now, one of the biggest problems amongst traders is that they think the market is static. So they also think that the trading plans are static, that once you have a trading plan, you can just execute it forever without changing anything. But changes in volatility, in liquidity, the way orders are executed, new technology, all these external influences, and there are probably many more, they all affect the market. And all of these things happen constantly. That leads to a market that has subtle changes over time. So for example, a year from now, the market as we know it might seemingly operate the exact same. But if you take a look at your data is just slightly different in, for example, 2027 compared to 2026. There are different types of problems that you run into. So for you to change with it, the solution is understanding the innovation cycle. Everything is always evolving. Everything you see around you is always getting better or worse. Nothing ever stays the exact same. And if it stays the exact same, it probably means it's getting worse because the rest of the world is catching up. Now, some like to call that invention. Now, for me, the word inventing implies that, for example, this phone was created out of thin air, which is rarely true because it's always based on a previous version. So to fully drive this point home and to fully understand where this actually starts in order for us to find a solution, I'm going to give you an example of the iPhone. I'm going to play 2 short clips of Steve Jobs introducing the iPhone in 2007. And I want you to pay attention to what he mentions specifically.
And they all have these plastic little keyboards on them. The problem is that they're not so smart and they're not so easy to use. And what's wrong with their user interfaces? Well, the problem with them is really sort of in the bottom 40 there. It's this stuff right here.
Because the iPhone didn't just get invented out of thin air, it was based on a previous version. Like Steve Jobs mentions, he mentions twice what the problem is, and then afterwards he mentions again what the problems with these older versions are. He realized that the keyboard on older versions had its limitations. There was a problem there. So what he did, he introduced something new. He found a solution to that problem and introduced something new, which of course you could make the argument that is exactly what an invention is. But I would argue that's just purely innovation because you're taking a seemingly worse previous version and you're now fixing a problem that the previous version has and you're making it better. So for example, in later years, they realized, well, the phone is a little bit small. Let's make it bigger. The camera is not that great. Okay, let's make the camera better. So there's constantly, for the innovation cycle to happen, there's a problem and there's a solution. And that's with anything around you. That's why things evolve the way they do, because someone finds a problem with the existing version. Someone thinks it can be done better. They provide a solution and we evolve. And that's important to understand. So if we now start applying this to our own trading, and the first thing I need you to understand is that in itself is already the problem with most traders, because what do? They avoid problems. Most traders see problems as a bad thing. So the moment they have somewhat of a losing streak, they immediately start completely throwing that strategy out of the window and they start looking for a complete new strategy. But that new strategy is again going to have problems again. You're always going to run into problems. So the main problem at this moment in time for most traders is avoiding problems. You don't want to avoid problems because when you're avoiding problems, inherently what you're doing is you're avoiding the innovation cycle. In plain terms, which means you're doing yourself a disservice and you're just making yourself worse and worse because you're not innovating, you're not getting better. Because the only way you can get better is finding a problem, finding a solution to that, and then moving on to the next problem, finding a solution and consistently doing that. And just before we move on, I think this stems from human nature because most of humans in general, they always perceive problems as something negative. Everyone is always complaining when they have problems. So a good example that I always think of is if you, for example, ask the universe or you ask your God, hey, I want to be more patient. And the universe or your God starts throwing these things at you to test your patience. If you pass that test, you become more patient. But the problem is most people perceive that as a problem, as a negative, so they try to avoid it at all costs. Now you can apply the exact same thing to most traders asking, I would like to be profitable. Then the moment they get handed the problems that they need to overcome in order to become profitable, they start running away and they think this whole thing doesn't make any sense. So what I like to do in my own life is I love finding problems, because every problem is just another opportunity to improve. And the first thing before we actually start providing you a solution to these problems is, of course, we need to identify what the exact problem is. So in order for us to do this, we need to understand what is a problem at this moment in time and what isn't a problem. So you first want something that you always stick to, a certain strategy. So for example, for myself, that might be, if I go into ES, I decide I always trade the futures right here. I mark out, let's say, this fair value area right there, then this is going to be my area of opportunity, just a vague example, right? And then here I might go into the 15-minute time frame to then look for an entry right there once we come into the area of opportunity. So I have somewhat of a clear idea of what I'm waiting for at all times. The same way, for example, you might say, okay, well, I'm always waiting for a bullish fair value gap right there, and then I go into the lower time frame to look for the entry confirmation to then continue higher. Perfectly fine. As long as you have somewhat of a vague idea of what you're sticking to. Now, the reason why it is quite important to understand is because if you don't have that and you're all over the place, we can't actually isolate the problems. I also need you to understand that not every loss is a problem, so don't overthink it. Problems in a trading plan, in my opinion, are something that repeatedly affects your profitability. So if you set the foundation of the trading plan and you take a trade and it ends up being a loss and it's just a one-time loss, it's just a one sample size, then that doesn't automatically mean that it's a problem. But for example, if you always take the exact same losses and you always miss the exact same trades, now those are problems, because they repeatedly affect your profitability. So I'm going to give you some examples. Now, to identify these problems, it all starts with journaling. So one of the first problems that I had in my trading, I started trading fair value gaps. I learned fair value gaps, the very basics from ICT. And ever since then, I just ran with it. So a very basic trading plan that I had is, for example, waiting for a higher time for fair value gap, looking for an entry confirmation within that higher time for fair value gap, to then continue lower again, for example. And that works, but I did notice I had repeated losses. And the repeated losses specifically came when I picked a higher time for fair value gap, where the third candle, for example, was a large retracement, leaving a smaller fair value gap. That affected the probability of my trade actually playing out. Or, for example, late 2024, at the start of 2025 as well, I had a problem where I had this new trading plan because I moved to the other side of the world, so I had a different time zone, so I couldn't apply the same things that I used to do. So I had to change things up a little bit. And I kept missing trades. And I journaled those trades because I kept missing them over and over and over. So there was something missing. Now, because I kept missing trades, that told me that I don't really know what I'm waiting for. That's why I'm missing the trades in the first place. So that's what eventually led me to develop the area of opportunity. Where, for example, I know exactly at this moment in time that this right here above this swing high is now where I would have gotten involved to then target the next few highs. That is my context area. Once I started implementing that, the problem was gone. So how do we actually identify the problems and the solutions for you? To make this a little bit easier, there are multiple levels to identifying what the solution might be. The first level is number one, the bias. When you open your chart, the first thing you're going to do is you're likely going to try and find a target, so the direction. So for example, here on ES, I might eventually come to the conclusion that this is the next target right there. Now, this is quite straightforward and you will probably know this for yourself as well. If you are quite good at the bias, so you don't struggle to know the next target and you see this always plays out right there, then you don't actually have a problem with your bias. Now, if you do see that your bias, your determined target is actually wrong quite often, but for example, you notice that a different instrument, a correlated instrument, so for example, instead of ES, it might be NASDAQ, that did actually play out and that did reach that same target, then that is the exact problem. And at the same time, that's also the solution. For example, picking the wrong instrument at that moment in time. If you're looking to buy, buying the strong instrument. If you're looking to sell, selling the weaker instrument. Or for example, if in general you're always wrong on the bias, it might be worth looking at the higher time frame, seeing what the higher time frame wants to do. Determine first that the higher time frame might be bullish and not going against the overall trends. And that might be your solution at that moment in time. Now, level number two is context right here. Context is essentially the area where you are eventually going to take the trade. Now, you can recognize that the problem is within that context if, for example, you also see that your bias does play out, but you're not a part of the move. So for example, like I had that problem with always missing trades. That was a context problem. Or for example, if the trades do actually play out, but you take a loss before you take the actual winner. So for example, right here, you might take a loss right there before the actual winner plays out and it still hits your target later on. The solution to those problems are often finding the exact area where you are looking to get involved. So for me, for example, that was really understanding, okay, I want to trade in between PDAs. So for example, the moment we disrespect this bearish fair value gap by running this rejection high, that rejection high right there, we can target the next bearish fair value gap right there. So I know this right here, this specific area is my context area. That's where I can start looking for my entry. So I know exactly what I'm waiting for, if that makes sense. That's essentially the same thing, for example, why a lot of people use, for example, a bullish fair value gap. A bullish fair value gap right there to target then the next swing high, the context high that we have right there. This essentially is your context area right there. That's why a lot of people, for example, use a market maker buy model, a market maker sell model, because those things tell you where to look for an entry. It's the context area. So if you take entries anywhere and they often result in a loss and afterwards it still plays out, that's a context area problem. The solution is in those areas where you are looking to get involved, where you are now going to look for an entry. Number 3, entry. Entry and context, oftentimes they go hand in hand, because oftentimes people think they have a problem with their entry, which they do actually, but the actual solution is in the context area, like we just went over as well. But there are going to be cases, of course, where you do recognize the clear context area, but your entries, for example, are often too late. So a very good example of this is with Nico right here. So Nico came to us during a live session and mentioned, well, my trades oftentimes they result actually in losses, and he was taking order flow entries. That told us, well, the entry you want to enter ideally a little bit before we are about to reach the target, not when we are about to reach the target. So instead of taking an order flow entry, for example, you can start working with an expansion entry instead. He mentioned that if he had taken the same trades that he had already taken with order flow entries, and instead he would have used an expansion entry, his win rate would have gone up from 35% to 66%. And that's exactly the solutions that you're looking for. That's almost 100% increase in the win rate. Now, if you see in your journal that your entries across the board are quite inconsistent, it could also be worth to check that you actually know what you're waiting for. So you have somewhat of an entry set in stone. I'm always waiting for one fair value gap. I'm always waiting for an expansion candle. I'm always waiting for order flow, for example. So you exactly know what you're waiting for. Again, quite important to isolate the problem as well. So moving on to number 4. Number 4 is risk management. Now, risk management oftentimes goes hand in hand with psychology as well, which is number 5. So let's actually put them together right here. So one problem that you could have, and a solution to that could be for risk management, is that when you go break even, and those break evens oftentimes result in missed winners instead of prevented losses. If you see that in your journal, it might be worth it to consider removing your break-even rule at that moment in time. Or for example, with risk management is that you are messing with the overall data of the trading plan because you're closing trades too early, or you're adjusting your stop loss whilst you are in the trade. Oftentimes, yes, you could argue, of course, that is a psychology problem and it is linked to that, but those type of signals that you have, if you start doing that, oftentimes that's also a sign that you actually don't know what you should be doing. So because you don't know what you're doing, and now these emotions start to rise, you just start adjusting your stop loss, adjusting your take profit whilst you are in the trade. So oftentimes it's a sign that you should have a clear rule. Okay, when in the trade, I don't adjust my stop loss only if, for example, I am going break even based on this rule. Then very closely linked to that is, again, number 5, psychology. Now, the only thing right here that I want to mention regarding psychology is first, make sure that you are very clear on the rules that you have in your trading plan, that you know what you're waiting for, that you know what is expected from you before you actually start blaming psychology. Psychology definitely plays a role, but oftentimes it's easier to stick to your psychology if you know exactly what is expected from you. So if you have a clear context area, if you know exactly what type of entry you should be taking within that context area, if you know what is expected from you once you are in the trade and you're now managing your risk. Now all it is a trial and error cycle. You start implementing the potential solution and you see how it affects the data. So the way you want to go about that is, again, those missed trades that you've journaled, all those trades that you've journaled, the winners, the break evens, the losses, and the missed trades. You start implementing the potential solution into those trades and see how it would have affected the trade outcome. And if you do that for 10, 20 trades, you're going to have a very different outcome most likely. If it's barely any difference, it's probably not worth to implement a solution. But if, for example, with Nico, your win rate goes from 35% to now 66% with those exact same trades, that's a solution worth implementing and worth keeping. And this is something you want to continuously do, because the mistake is now, if you have found something that will actually make you profitable and you think, well, now I have a profitable trading plan and there's no need for me to change anything anymore in the foreseeable future. No, you always want to find the next problem, something you can potentially improve. And it doesn't mean you need to always be changing every single week. No, again, this is very subtle changes, right? This could be over years' time. You might make 1 or 2 slight changes, but it's absolutely key that you create a habit out of this so that you're journaling your trades, you're reviewing your trades, and you're seeing if something can be improved, if there is an active problem at that moment in time. So always look for that next problem and then potentially implementing solution, journaling again, reviewing. So if you have that cycle, if you have that routine, that habit essentially, you have no reason to be worried about the market consistently changing, because you are always changing alongside the market. Now, if this video helped you, I'm sure that this next video right here will also help you. So feel free to check that out. All right, perfect. Thank you.